Okay, spreadsheet time. So we're going to look at some of the scenarios we discussed in action in this video. What we're going to begin with is a direct comparison of a non-direct and direct recognition policy. So let's take a look here. What we're going to look at is a policy with a company that offers both non-direct and direct recognition. So we've got the same company with the same individual, same loan amount coming out of the policy. One example with non-direct, one example with direct recognition, so we could see the actual change in action here and see if it really makes a difference or not. A lot of columns going on. Let's first touch on the design. So when we look at policy loans, what I always like to look at first is the design to make sure that that policy is optimized for cash value and has a minimum premium. And a big reason why is if life happens and I can't make payments anymore, the policy has to pay for itself internally. The lower that premium is, the better off I am. So this was a policy where it was funded on a age 40 male, $50,000 per year for 7 years. 7 pay up to the limit each year, max funding it. Breaking even between years 3 and 4. By year 4, I've paid in $200,000. I have $200,000. Now, as we look at the year 18 cash value on the growth example, what do you notice? I'm sorry, year 19 cash value, $618,000. Death benefit is $1,479,000. That's what it looks like if I just let it sit and grow. Okay, always good to start with this because when I start to look at how loans actually impact my policy, which is your money in there, so I want to know what's going on with it and if it's in my best interest or not, what's it going to look like? Well, first, let's look at direct recognition. So what we've got here, exact same policy. There's your break-even point. We look at a policy loan at age 50 here. He wants to pull out $300,000. The loan interest rate with the direct recognition contract option is 6%. So what happens here? Pulls out $300,000, makes no payments other than interest in the first year, grows to $318,000. That's 6% of the 300. There's the loan interest. Here's my loan interest payment. Now the next year, we begin to pay the interest, which is always optional. We can pay the interest however we want. Same thing with loan repayments, but we're going to cover the interest and apply $50,000 per year toward the principal balance. So it is paid off year 19 by age 58. This is a direct recognition policy. The dividend rate here on the growth example is 5.65%. So you know what company this example is with. Now, the loan rate is 6%. So with that direct recognition policy, when I pull that loan out, what happens to my money? That $300,000 that is outstanding in loans, direct recognition. The company looks at it, directly recognizes it, and pays a dividend rate of 6%. So what happens when it's paid back, or I should say before it's paid back while I'm repaying it, is that loan balance, whatever that is receiving that 6% dividend rate. Whereas the cash value, whatever's still remaining in cash value or equity, if I want to relate it to loaning against real estate, is receiving the company's basic 5.65% dividend rate. In the growth example, it was 5.65 all the way through. Here, 5.65 on the remaining cash value, and whatever is outstanding in loans receives that 6% dividend rate. A lot of info here. Here's what to look at. When it's paid back, in the growth example, it was $618. In the payback example, $624,000. So I see my cash value fully restored and a little bit more. Also, if I look at my death benefit, at 1.94. In the growth example, 1.479 versus 1.494. About $15,000 more. So a little bit higher in the cash value and death benefit because the company applied that adjusted dividend interest rate on the borrowed funds because they are direct recognition, directly recognizing the fact that we take out a policy loan. Versus the next column over here on the far right. Loan to repay with the non-direct recognition contract option, in which the variable loan rate is 4.5%. So it's very common. With non-direct recognition, most companies will have a variable loan interest rate associated with that, versus direct recognition, you'll often see a fixed loan interest rate associated with that. The only company I've seen that does things a little bit different there is Penn Mutual, where they have a variable loan rate with a floor of 5%, but they also practice direct recognition. And you can check out our All About Penn Mutual video if you're interested in more info on them. So here, exact same policy. You'll see the same break-even point. Cash value's identical through year 10. We take out that $300,000 loan. So, non-direct recognition. They do not recognize the fact that we take out a loan. So that dividend rate of 5.65% is applied to any money in cash value and any money outstanding in policy loans. So as we repay it, there's the same principal repayment. There's the interest payment though. So in this example, we are paying less to the insurance company because the interest rate is 1.5 lower. Now, when it is paid back, what do you notice about the cash value and death benefit here? 618, 1.479. In the growth example, 618, 1.479. Everything's fully restored to exactly what it would have been as if I never touched it in the first place. That is non-direct recognition. So is one better than the other? Not really. I mean, when you really look at it, this is based off an illustration here. When we look at actual data with loans coming out, being paid back in, we don't really see much of a difference there in terms of real performance. And you can make an argument for either company. We like both. We use both, obviously. The biggest thing, in my opinion, is just understanding how the products work, how non-direct, how direct recognition works, understanding it, and then making a decision from there, along with everything else that can weigh into our decision. This way we know it. The thing that people hate, myself included, is to buy something or invest in something and then find out after the fact something else existed, but I wasn't told about it. That's where frustration can come up. We work with a ton of engineers, analytical individuals, CFOs, people that like the numbers and such. What will frustrate them, and I'm the exact same way here, is again, not providing all the information, or they think they have it all because you told them certain things, but then find out after the fact, hey, you skipped over this piece of information, and you might view it, it's no big deal, but it's a big deal to them. Got to make sure we go through the important items, make it available. I'm talking more about our business practice here. So I hope this one was helpful. I know we mentioned we're going to look at several spreadsheets. We're going to break it up now just because of the sake of time. We're going to look at the different repayment options in the next video. Hope this one helped. Talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.